Close your laptop, turn off your trading alerts, tell your spouse you'll discuss dinner plans later. Because what Bank of America just revealed about silver will fundamentally change how you think about your portfolio. They're calling silver the dazzling protagonist of 2026. They're projecting a target range that reaches $309 per ounce. And if this is true, the investment landscape cannot go back. Most people heard Bank of America's headlines and focused on their $5,000 gold forecast. That's exactly what they wanted you to do. While everyone was distracted by the shiny gold number, the real story was buried in the technical analysis. Michael Widmer, their head of metals research, didn't just throw out a silver price target. He revealed something far more dangerous, a structural breakdown that's been building for 5 consecutive years. Here's what people think is happening. They believe Bank of America is simply bullish on precious metals due to inflation fears and monetary policy uncertainty. Standard Wall Street precious metals narrative, safe haven demand, currency debasement, the usual talking points. But that's not the complete picture. The contradiction lies in the numbers themselves. Bank of America expects total silver demand to fall 11% in 2026. They are projecting reduced industrial consumption, particularly from solar panel manufacturing, as the industry shifts to TOPCon technology that uses less silver per panel. So why are they simultaneously forecasting the most aggressive silver price targets in modern history? This is where the narrative breaks. The hidden mechanism is what Widmer calls structural tightness. While demand may decrease in certain sectors, the supply side has been fundamentally broken since 2021. Silver has been in deficit for 5 consecutive years. Global demand reached 1.24 billion ounces in 2025. Mine production delivered only 813 million ounces. That's a 427 million ounce shortfall that had to come from somewhere. But here's the part nobody priced in. The London silver market is showing extreme stress signals. Lease rates, the cost of borrowing physical silver, spiked dramatically in recent weeks. This happened because silver was transferred to New York in anticipation of tariffs that never materialized. The result? London vaults are now materially tighter than they've been in years. When lease rates spike, it means one thing. There's not enough physical metal available to satisfy borrowing demand. Industrial users, refineries, and short sellers all compete for the same limited pool of available silver. And when that pool shrinks, the price mechanism stops working normally. Bank of America's real insight isn't about demand growth. It's about the gold to silver ratio. Currently sitting at 59:1, this ratio suggests silver is historically undervalued relative to gold. Widmer's $309 target assumes the ratio contracts. The escalation comes from understanding what happens when institutional money recognizes this dislocation. Bank of America notes that precious metals now represent over 5% of global equity and bond markets, up from 2.8% just 2 years ago. But here's the crucial detail. Most of that allocation went to gold. Silver remains institutionally underowned. ETF inflows into gold funds like GLD surged 880% year over year in September 2025, totaling $14 billion. Silver ETFs saw nowhere near that level of institutional interest. Yet silver delivered 148% returns in 2025, compared to gold's 65% gain. The performance discrepancy is creating recognition that silver offers superior leverage to the precious metals thesis. Now the mid-story reversal. The real winner isn't gold holders or even current silver investors. It's the institutions that recognize this setup before the ratio compression begins. Bank of America is essentially telling their institutional clients that silver offers asymmetric upside relative to gold. They're positioning for a trade that could deliver 3 to 4x returns if the historical ratio relationships reassert themselves. But there's something they're not emphasizing in their public communications. The supply deficit isn't just a short-term phenomenon. It's structural. Silver mining production has been declining despite higher prices because the easy-to-extract deposits have been exhausted. New mine development takes 7 to 10 years and requires silver prices significantly higher than current levels to justify the investment. Meanwhile, industrial demand continues to evolve. Yes, solar panels are using less silver per unit, but artificial intelligence data centers, 5G infrastructure, and electric vehicle adoption are creating new demand sources. The U.S. government recognized this reality in 2025 when they added silver to the official list of critical minerals, putting it in the same category as rare earth elements essential to national security. Here's where the systemic consequence becomes clear. If Bank of America's forecast proves accurate, silver's performance would dwarf every major asset class. A move from current levels around $99 to $309 represents a 243% gain. That's the kind of return that forces portfolio reallocation across the institutional investment landscape. But the implications extend beyond just silver holders. A precious metals bull market of this magnitude suggests significant stress in the broader financial system. Central banks have been buying gold at record levels, with their gold reserves now exceeding U.S. Treasury holdings for the first time in modern history. This represents a fundamental loss of confidence in dollar-denominated assets. When silver outperforms gold by the margins, Bank of America, yet most investors remain completely unaware of these dynamics. They're focused on stock market volatility, bond yields, and cryptocurrency trends, while missing the setup that Bank of America's research team believes could deliver generational returns. Now, let me show you the specific data that makes Bank of America's forecast so alarming. They're not just looking at supply and demand fundamentals. They're tracking institutional positioning patterns that haven't been seen since the 1970s precious metals crisis. In their internal modeling, Bank of America identified 3 critical threshold points. Second, they've calculated that central banks worldwide are still dramatically underallocated to gold, averaging only 15% when optimal reserve diversification suggests 30%. The mathematical implication is staggering. If central banks globally move toward optimal allocation, it would require purchasing volumes that dwarf current market capacity. Third, and most importantly for silver, they've identified that the gold to silver ratio compression isn't just possible, it's mathematically inevitable given current supply constraints. When I say inevitable, I mean the physical market cannot support current pricing differentials indefinitely. Here's what Bank of America's research team discovered that changes everything. The London Bullion Market Association, the organization that oversees global precious metals trading, has been quietly reporting delivery stress across multiple quarters. Not just delays, actual allocation failures where buyers couldn't source contracted metal. This is unprecedented in modern precious metals markets. When delivery systems start failing, price discovery mechanisms break down. The paper markets, where most price quotes originate, lose their connection to physical reality. And when that happens, prices don't just rise gradually, they gap violently to wherever physical buyers are willing to pay. Bank of America's $309 silver target suddenly looks conservative when you understand the delivery infrastructure is already showing stress at current price levels. What happens when industrial buyers start competing with investment demand at $150, $200, $250 per ounce? The timing element reveals why Bank of America is communicating this forecast now. They're seeing accelerating institutional recognition of precious metals as a mandatory portfolio allocation, not a speculation, not a hedge. A core holding required for portfolio stability in an unstable monetary environment. Consider the broader context. U.S. national debt continues expanding at unsustainable rates. Government spending shows no signs of fiscal restraint regardless of political leadership. The Federal Reserve remains trapped between inflation control and economic support. These aren't temporary challenges. These are structural problems that don't have policy solutions without significant economic pain. In this environment, institutional investors are forced to seek assets that preserve purchasing power independently of government policy decisions. Real estate works until property taxes and regulations make it politically vulnerable. Stocks work until corporate earnings get crushed by higher interest rates or economic recession. Bonds work until inflation erodes their real returns. But precious metals, especially silver with its dual industrial and monetary demand profile, offer protection against both inflation and deflation. During inflationary periods, silver benefits from currency debasement. During deflationary periods, silver benefits from flight to quality demand and reduced mining supply as marginal producers shut down. Bank of America's research team understands this dynamic. Their $300 forecast isn't predicting a speculative bubble. It's projecting the price level required to incentivize sufficient new mining supply to restore market balance. And those price levels are dramatically higher than current market expectations. The geopolitical dimension adds another layer of urgency to their analysis. Silver's designation as a critical mineral means national security considerations now influence market dynamics. Countries that control silver mining and refining capacity gain strategic advantages in technology manufacturing and energy infrastructure development. China dominates silver refining despite not being the largest mining producer. They process roughly 60% of global silver concentrate into finished products. This creates potential supply chain vulnerabilities that industrial users in other countries are beginning to recognize and hedge against. Bank of America's institutional clients include the largest technology companies, defense contractors, and energy infrastructure developers in the world. When they issue a forecast suggesting silver could triple or quadruple in price, they're essentially telling these clients to secure supply chains before prices make current business models unviable. The knock-on effects cascade through every industry that depends on silver for manufacturing. Solar panel producers, electric vehicle manufacturers, electronics companies, medical device makers, all of these sectors would face dramatic cost increases that would force either product price increases or technological substitutions. But here's the critical insight Bank of America isn't emphasizing in public communications. There are no technological substitutions for silver in most critical applications. Its electrical and thermal conductivity properties are irreplaceable in high-performance applications. Industrial users facing silver shortages can't simply switch to copper or aluminum without significant performance degradation. This creates what economists call inelastic demand. When price increases, don't reduce consumption because no alternatives exist. And inelastic demand in a supply-constrained market produces price explosions, not gradual increases. Bank of America's models account for that. But achieving that balance requires destroying industrial demand for non-critical applications while maintaining supply for essential technologies. The investment implications extend far beyond precious metals portfolios. If silver reaches Bank of America's price targets, every technology company, renewable energy developer, and electronics manufacturer faces margin compression from input cost inflation. Stock market valuations across these sectors would need significant adjustment. Meanwhile, silver mining companies would experience leveraged returns to their reserves and production capacity. Bank of America calculates that mining stocks could deliver 300-500% returns if silver reaches their upper price targets because their production costs remain relatively fixed while revenue multiplies. But here's the cliffhanger ending that should concern everyone. Bank of America's $309 target assumes current market structures remain intact. It assumes London silver markets continue functioning. It assumes industrial users can source the metal they need at elevated but manageable prices. What if those assumptions prove optimistic? What if the physical silver shortage becomes so acute that price discovery breaks down entirely? What if industrial users start hoarding metal, creating a supply squeeze that makes current projections look conservative? The structural problems Bank of America identified aren't resolving, they're intensifying. The 5-year supply deficit is entering its 6th year. London lease rates are spiking. Industrial demand may be shifting, but it's not disappearing. And institutional recognition of silver's asymmetric potential is just beginning. Let me break down how Bank of America expects this price explosion to unfold through 4 distinct phases. Phase 1 is already underway. Institutional recognition of precious metals as mandatory portfolio diversification. Price appreciation remains relatively orderly, driven by consistent buying from pension funds and sovereign wealth funds. Phase 2 begins when industrial users recognize supply constraints aren't temporary. Manufacturing companies start building strategic silver inventories, moving from just-in-time procurement to securing months of future production needs. This shift creates the first major supply shock. Phase 3 triggers when delivery failures become widespread. When major buyers can't source contracted metal at quoted prices, paper markets lose credibility. Physical premiums explode and regional price dislocations become permanent. Phase 4 represents complete market breakdown where price quotes become meaningless because no metal changes hands at posted levels. All transactions occur through bilateral negotiations. Bank of America's $309 target assumes markets reach this phase. The terrifying aspect is acceleration potential. Each phase can trigger rapidly once threshold conditions are met. Bank of America research suggests these phases could compress into months if institutional recognition accelerates or geopolitical events disrupt supply chains. Consider the portfolio mathematics. If silver represents less than 1% of institutional portfolios, but delivers 300% returns while stocks struggle, rebalancing requirements force additional purchases. This creates a feedback loop where performance drives allocation drives performance. But Bank of America identifies an even more dangerous dynamic. The wealth effect from silver appreciation creates spending power that bids up other real assets. Property, farmland, and commodities all benefit from precious metals holders diversifying gains. The Federal Reserve faces an impossible choice. Monetary tightening to combat silver-driven inflation would devastate growth. But accommodation would validate currency debasement concerns and accelerate capital flight from financial assets. Bank of America's modeling suggests Fed credibility becomes the critical variable. If markets believe the Fed can restore stability, silver might stabilize at lower levels. But if credibility erodes, precious metals become the preferred monetary alternative. The international dimensions add complexity. Central banks hold 36,000 tons of gold, but less than 1,000 tons of silver in reserves. This allocation disparity means silver offers far greater leverage to monetary debasement themes than gold. When central banks diversify from dollar assets, they buy gold because liquid silver markets can't absorb central bank transactions without extreme volatility. But private investors can access silver more easily, creating arbitrage opportunities. Bank of America calculates that if just 10% of global gold investment demand redirected toward silver, it would exceed annual mine production. The mathematical impossibility of satisfying this demand forces dramatic revaluation. Technology sectors face acute risks. AI data centers require substantial silver for computing applications. Electric vehicles depend on silver for battery systems. 5G networks need silver for advanced circuits. These aren't optional upgrades, but mandatory infrastructure driven by competition and regulation. Bank of America's research indicates technology companies are recognizing procurement risks. Some firms are establishing strategic purchasing programs, moving beyond just-in-time management to securing multi-year inventory buffers. When technology giants compete with investment demand for limited supply, traditional dynamics become obsolete. These companies have unlimited purchasing power when silver represents small production costs, but critical competitive advantage. Mining response creates additional complexity. Silver expansion requires 7 to 10 years for new projects and sustained high prices to justify costs. But environmental constraints and regulatory opposition limit supply response more than historical precedents suggest. China's refining dominance creates vulnerabilities. Even if mining occurs in friendly countries, Chinese processing controls transformation to industrial-grade silver. Trade tensions could fragment global markets. Bank of America's clients include defense contractors facing national security implications from supply disruptions. Their $309 forecast tells these clients that current prices do not reflect supply chain risks and strategic inventory value. The investment implications extend beyond buying silver. Traditional portfolio diversification becomes inadequate when monetary stress drives precious metals to extreme valuations. Stocks and bonds both suffer when precious metals outperform by these margins. Real estate might benefit initially from wealth effects, but faces longer-term pressures from tax increases as affordability deteriorates. Only hard assets with no counterparty risk maintain protection in extreme debasement scenarios. Bank of America's forecast forces fundamental questions about modern portfolio theory. If traditional assets lose diversification benefits simultaneously, what framework replaces stock bond allocation models? Their research suggests much higher real asset allocations, including metals, commodities, and productive land. But these markets lack liquidity to absorb capital from stocks and bonds. This creates transition risk where traditional assets decline before alternatives can absorb displaced capital. Federal Reserve policy becomes increasingly constrained because traditional tools lose effectiveness when investors lose confidence in currency-based wealth storage. Raising rates to combat inflation would devastate growth. Lowering rates would accelerate debasement and drive more capital into hard assets. Bank of America's forecast projects a policy trap where monetary tools become ineffective. That's not a temporary cycle, but a regime change that restructures the financial system around hard assets rather than financial accumulation. The timeline compression makes this dangerous for unprepared investors. Bank of America is not forecasting gradual appreciation over a decade, but dramatic revaluation within 12 to 24 months as institutional recognition accelerates. Most investors remain positioned for traditional market dynamics, optimized for stock and bond performance, with minimal precious metals allocation. When institutional money rotates toward hard assets at the scale their models suggest, traditional portfolio construction becomes obsolete. But here's the most unsettling aspect. Bank of America's $309 target assumes orderly market functioning. It assumes London clearing systems continue operating, mining companies can access capital markets, and industrial users can source metal at elevated but predictable prices. What if these assumptions prove optimistic? What if supply shortages become so severe that market mechanisms break down entirely? What if governments restrict precious metals exports or delivery failures spread globally? Bank of America's research team has identified early warning signals suggesting these scenarios aren't theoretical. Lease rate spikes, delivery delays, vault inventory drawdowns, and strategic hoarding are occurring simultaneously. This convergence hasn't been seen since the 1970s precious metals crisis, when silver briefly traded above $50 in inflation-adjusted terms. But today's structural imbalances are more severe, industrial dependence greater, and monetary policy options more limited. Consider what happens when the paper markets completely decouple from physical reality. Bank of America's analysis shows we're already seeing early stages of this breakdown. When London lease rates spike to 15-20%, it signals that the normal flow of metal between locations and timeframes has been disrupted. The futures markets depend on the assumption that physical delivery can occur at expiration. But when vaults are empty and refineries are backlogged, that assumption breaks down. Futures become purely financial instruments disconnected from the underlying commodity. Bank of America's institutional clients understand this risk. They're not just buying paper exposure to silver. They're securing physical allocation in advance of the breakdown. When the largest financial institution in America tells its clients that silver could reach $309, it's not speculation. It's strategic positioning based on mathematical analysis of supply-demand imbalances. The wealth preservation implications extend beyond just precious metals appreciation. When traditional stores of value lose credibility, society restructures around scarce physical resources. That's not just an investment theme, It's a fundamental reorganization of economic relationships. Bank of America didn't just issue a price forecast. They revealed that the silver market is approaching a breaking point where normal relationships